Hello and welcome. So as discussed, this is a specific video on the credit rating agencies. Now coming to this editorial first and foremost, now this editorial is a very specific one. It does not have all the dimensions related to the credit rating agencies and their structural flaws. So the discussion is not going to be limited to this particular editorial, rather it will be an all-encompassing one. So let's start the discussion. The first issue is with regards to the history of credit rating agencies. Now they came into prominence in the year 1837. Now what happened in 1837 is that there was a financial crisis in the US, and after that there was a need felt that there should be some degree of rating that should be provided about the credit worthiness of the merchants. So in that respect, this business of credit rating first started. Later, the demand for this continued to rise in the US. The demand was rising largely because the markets required some independent information. They also required some trustworthy analysis of the credit worthiness of the merchants. So rising demand and the situation led to a rise of the credit rating agencies as a business. Now, later, three big credit rating agencies is what has emerged, and they continue to exist even today. One is Fitch. The second is the Standards and Poor. And the third is the Moody's. You should know that the Moody's had recently upgraded India's rating to AAA. So that is why Moody's becomes more important. Another thing is that after the year of 1960, these credit rating agencies have started a new business model. Now, as per this newer business model, they are catering both to the investor as well as they are catering to the entity. Now, previously, they were only catering to the investor. That means that if I want to invest in a particular company, either through a stock market, or for that matter, I am a banker and I want to give some money to a particular company, then they would provide some information to me of whether or not this company is credit worthy. Now, that was the entire function previously. Now, they have taken up some non-core functions, which we shall be discussing in detail later. But you should know at present that yes, they are now catering to the company, to the merchant also, who is seeking this investment. So that is something that you need to know. Another thing that you need to know is about the repeated allegations of improper and inaccurate ratings by these credit rating agencies. Now, this is primarily important from the context of the 2008 financial crisis. Now, this crisis firstly began in US. Now, what happened at that point of time is that approximately 45,000 mortgage-related securities before this crisis till 2007, these 45,000 mortgage-related securities had a rating of AAA by the credit rating agencies. That means these credit rating agencies had failed to predict the crisis that was building up in the US economy, which led to the financial crisis of 2008. So this is something that you need to know. Later, you need to know that in the year 2010, of these 45,000 mortgage related securities, only 6 had a AAA rating. So you can clearly understand that how much was the difference between these 45,000 and only 6. So definitely there was a case against these credit rating agencies. So this is something that you need to know. Another thing that you need to know here is that time and again globally they have been accused of giving false ratings, and what has happened is that they have multiple times been fined. They have been fined to the tune of millions of dollars. So this is something that is important here. Now coming to the basic analysis of the core and the non-core business. Now, first and foremost, the core business, as I've discussed, they provide a credit rating to the company that is seeking an investment, either through a bank as a bank loan or through the investors through stock markets. For example, if a company wants to raise some capital through a capital market by releasing its shares or equity for that matter, then in that case, what happens is that the credit rating of that particular company is given by these credit rating agencies, and the investors will pay to these credit rating agencies some minor fee from their investment for telling them which company they should invest in. So that is the core business. Now, what is the non-core business? The non-core business here is some other activities which these credit rating agencies are doing. For example, they provide a pre-launch consultation. For example, a company A wants to raise 1,000 crore rupees from the market, and this company decides that it is going to do that by releasing some shares. Now, before releasing these shares, what this company is going to do, it goes to these credit rating agencies and asks for a pre-launch consultation. For this, maybe this company is going to pay approximately 20 crore rupees of fee. And this credit rating agency is going to study the market, and it is going to tell the company A whether or not the market is at a good pace, or whether or not it is the right time for it to release its shares. So that is something that That is one service which the credit rating agency is going to provide to this company A. Now, if the decision finally is taken that the shares will be released, then what will happen is that this same company is now going to provide a rating to this company A. So you can see that there is a cycle here. So if this particular company has already paid 20 crore rupees to the credit rating agency, now this can impact the ratings that the credit rating agency is going to give to this company. And this is the issue of conflict of interest, which is something that is important and which is going against the genuineness of these credit rating agencies. So this is one conflict area which is important for you to understand. Now, coming to the issue specific to India, first and foremost, what you need to know is that in the year 2015, there was an Amtech Auto case. Now, what happened in this Amtech Auto case was that this company, Amtech Auto, had released some bonds to raise some capital from the bond market. And approximately 800 crore of money is something that this company failed to pay back to its investors, and it defaulted on this sum. Now, despite the fact that this company defaulted, the company had a very good rating. It had a AAA rating. So this was something that brought to the light the false ratings which are being given by credit rating agencies, and this is something that is misguiding the investors, and this led it for the SEBI to intervene in this matter. So this is something that is important. Now, in the year 2017, the SEBI has proposed, yet these norms have not been implemented, they are only proposed. SEBI has proposed some newer norms for regulating the credit rating agencies. Now, the first norm is with regards to restricting cross-shareholding between rating agencies. SEBI has said that it wants to restrict this to 10%. Now, what do you understand by this cross-shareholding? Suppose there are 3 credit rating agencies, A, B, and C, and all these credit rating agencies give independent ratings to a particular company. Now, it might happen that these companies are investing within each other. For example, instead of being 3 separate companies, they decide that they will invest in each other and will become a single entity. For example, A wants to buy 30% of the shares of B. Then what will happen is that you can clearly see that because these 2 companies are now linked, they will not be able to give independent ratings. A and B will give collective ratings, and later if B also invests in C, then all 3 will give collective ratings. Now, what happens as a result is that a herd mentality is something that will be prevalent, and independent ratings will not come. So genuineness in the market is something that is going to be defeated. So to curb these tendencies, SEBI has now made a norm that if any company wants to invest more than 10% in another credit rating agency, then it will have to take the permission of SEBI. So this is something that has been advocated. Another thing is with regards to an increasing in minimum net worth. Now, for anybody to start a credit rating company, initially it required a capital of 5 crore. That is a net worth of 5 crore rupees. Now, this sum has been raised to 50 crore. Now, this has some advantages and disadvantages. The advantage is that this company will have a higher net worth, as a result of which it will be able to hire more quality employees. It will be able to pay them more. So some good pool of people will be employed in this particular company, and this will increase the intellectual capacity of the company. So the quality is something that is definitely going to be increased. But the issue is that this is going to defeat competition in the market. For example, I want to start a credit rating company. I shall not be able to start it until and unless I will have this huge sum of 50 crore rupees. So this is one issue which has been analyzed, that a sum of 50 crore rupees is a very high sum. So this is going to stamp the competition in credit rating markets. And this is something that is going to result in very few companies of credit rating which will be there. So that is something that is a negative of this. Another thing is that SEBI has proposed that there should be a mandatory 5 years experience which any company should have before it gets established as a credit rating agency or a credit rating company. So that is something that you need to know. Another thing is that SEBI has made the disclosure norms more stringent. For example, if a credit rating agency has performed some non-core business for a particular company, then it will have to disclose about this services which it has provided before it rates that company. So that is something that is a good step. It will ensure greater accountability and transparency. So that is something that is important. Another issue is with regards to rating shopping. This is a major problem in India. Now here you need to understand that rating is not something that is a subjective matter, rather it's an objective analysis of a particular company. If a company is not doing good, then in that case all the rating agencies should have similar ratings for it. But this is not what happens. If a company A wants to raise some capital, then it will go to one rating agency. If the rating agency is not giving it a good result, it goes to another rating agency until it finds a rating agency which will give it a good result. So this is something that results in a tendency of rating shopping, and this is something that should be regulated and checked. So that is something that has been analyzed. Another thing that you need to understand is the lack of alternative services. Now the problem with India is that in India there are very few number of credit rating agencies indigenously, and globally also it is the big three which are more prevalent. So that is resulting to the another problem of an oligopolistic market. That means only few amounts of companies are present, and as a result of which the market is not deepened, and so there is a tendency of herd mentality or for some degree of corruption in ratings. So this is something that is important, and there is a case for increasing the number of credit rating companies, and for this it should be sure that the steps to form a credit rating agency is something that is eased. So that is something that has been analyzed. This step by the SEBI to raise the capital is starkly against this idea of doing away with oligopolistic markets. So that is something that is important. Another thing which is important is with regards to a proposal of a government rating agency. Now, many a times it has been proposed that because there is so much of complexity in the issue of credit rating, why not have a government credit rating agency which acts independently? So, indeed, this is a good idea, and you can favor this idea in your answers or in your analysis. But what is the problem with related to the government rating agency is that it might raise some question upon the government interfering in the capital markets, or for that matter in the private sector. So it might lead to some degree of a license raj, or it might lead to a nexus of some corruption between the private sector and the public sector. So that is one issue. Another issue is that there might be questions raised by the ratings that this government rating agency is going to give to the public sector undertakings. For example, some public sector undertaking like the SAIL or the ONGC, they might be getting some good ratings. So that is something that is questionable here. But this idea is something that is important, and this is something that can be explored. So this is something that is important here. Another thing that you need to know is with regards to the global impacts of the rating agencies. Now, these rating agencies previously were only limiting themselves to rating private companies. But today they have made a stark shift, and they are not only rating these private companies, but they are rather rating countries as a whole. They are even rating the sovereign bonds of the of countries. For example, as I told you, Moody's has recently upgraded India's ratings. So indeed, they have a lot of global impact. For example, they can impact the fiscal fortunes of a nation due to flight of capital. It might happen that one night Moody's suddenly degrades India's credit rating. Then in that case, a lot of capital, that is hot money, which has been invested in Indian securities, is something that can suddenly leave, and it could destabilize the economy of a country. So that is something that you need to know. For example, these rating agencies had given the status of the junk status to Greece, Portugal, and Ireland, and as a result of which these three countries, they defaulted. There was a sovereign debt crisis. Nobody was ready to give any debt to these three countries. It even led to the problem of Eurozone instability because Germany had given them some debt. So all of those problems prompted because of this lowering of the ratings by the rating agencies to these three countries. So that is one example which has been given. Later, it resulted in a lot of distress in these countries. There is a high level of unemployment that is there in these countries. The economy of these countries is unable to rise. So all of these global impacts is what is happening because of the rating agencies. Also, with regards to Russia, China, and India, something that you need to know. Russia and China have had their own now, set up their own rating agencies, and they are not following global rating agencies. So this is something that you need to know. Now, with regards to India, India has time and again complained that India has really made severe strides economically, and India has complained that India's economic progress is often not acknowledged by these rating agencies, who have been reluctant in upgrading India's ratings. So that is something that even India had a problem with. Even Indian Prime Minister had time and again said that there is a need to ensure more independent rating agencies. Even on the BRICS podium, Indian Prime Minister had said that BRICS should have a separate rating agencies for its own countries, and it should not depend so much upon foreign rating agencies. So all of these issues is in specific to Russia, China, and India is something that you should know. Also, you should know that sometimes these ratings are also politically motivated. For example, in the year 2014, Russia annexed the Crimean Peninsula in Ukraine. So what happened is that right after this annexation by Russia, Standards and Poor lowered Russia's credit rating, and it lowered it to a status just above the junk status which is given to Greece, Portugal, and Ireland. So these kind of moves sometimes smack of political influence on these rating agencies. So that is something that has some global impact. So this is something that is important. Next, you need to know about the suggestions which have been mooted for doing away with the ills of these credit rating agencies. Now, largely these suggestions are specific to India, so because these suggestions is what is vital for you from UPSC perspective. So that is what I have focused on. First and foremost is that of an indigenous rating agencies. I've told you previously also the problem is that of oligopolistic markets in rating agencies. So definitely more and more indigenous rating agencies is something that should be looked into. Even Prime Minister has called for this. So this is something that can be done. Another thing is that SEBI can ensure some newer reforms. For example, it can put a ban of core and non-core business. It can strictly monitor this, that a company which is into rating agencies cannot provide non-core services. So this is something that can be experimented with. So that is something that has been analyzed here. Another thing is with regards to a fixed fee model. Now it often happens is that these credit rating agencies, they have a different fee for providing the rating. So it might happen that if I am a company A and I want a rating, I will probably go to that rating agency which is providing the least bid. So this sometimes happens that because of providing the least bid, the credit rating agency often compromises on the quality of its functioning. So to do away with this issue, a fixed fee is some model that can be adopted, that for providing any ratings, the government can set up a fixed fee which will have to be paid. So this will ensure some quality. So that is something that has been analyzed here. Another thing is with regards to outstanding ratings and sudden downgrades. Now here what has been analyzed is that if a credit rating agency is giving some outstanding ratings to a particular company, or it suddenly downgrades the ratings of a particular company, then in those specific cases, greater regulation and vigilance is something that should be maintained by the regulator, in this case SEBI. Because it might be because of these sudden outstanding ratings or sudden downgrades, might be because of some corruption or some other issues. So this is something that has been analyzed here. Another thing is with regards to changing rating agencies. Now you should know that in India there is already a norm that auditors have to be changed time and again. So it has now been advocated that not only the auditors, even the rating agencies is something that should be changed repeatedly. A company should not be allowed to continuously get ratings from one rating agency only. So that is something that has been analyzed. Another thing is that there should be a shift from issuer pays model to an investor pays model. At present, as I told you, even the entity which is seeking a rating is paying the rating agency. So this is the issuer pays model. This should be shifted to now specifically an investor pays model, so that the entire loyalty of these credit rating agencies is towards the investor whose interests they have to protect. So that is something that has been analyzed in this particular editorial also, and this entire topic of credit rating agencies is important. So this is a comprehensive analysis here. I don't think a question can come outside our discussion on this particular topic. So that is the relevance here. Now with this, we finish today's discussion. I thank you all for watching and I hope to see you tomorrow.